Welcome to our in-depth guide on understanding index funds. If you're looking for a clear, comprehensive explanation of what index funds are, how they work, and why they might be a smart choice for your investment portfolio, you're in the right place. This video is designed for anyone curious about investing, from beginners to seasoned investors looking to refresh their knowledge. We'll break down complex financial concepts into easy-to-understand terms, helping you make informed decisions about your money. By the end of this video, you'll have a solid grasp of index funds and feel more confident about incorporating them into your financial strategy. So what exactly is an index fund? In simple terms, an index fund is a type of mutual fund or exchange-traded fund, ETF, with a portfolio constructed to match or track the components of a financial market index, such as the S&P 500 or the Dow Jones Industrial Average. Instead of having a fund manager actively pick stocks, an index fund simply buys the same investments in the same proportions as a specific market index. For example, an S&P 500 index fund would hold stocks of all 500 companies in that index, aiming to replicate its performance. This passive approach means the fund's performance mirrors that of the index it tracks. Index funds are known for several key characteristics that make them attractive to investors. These include their diversification benefits, low management fees, and a passive investment approach. One of the most significant advantages of index funds is diversification. Because an index fund holds many different securities, it automatically diversifies your investment across various companies and sectors. This reduces the risk associated with investing in individual stocks, as the performance of one company won't disproportionately impact your overall portfolio. Another major draw of index funds is their typically low management fees, also known as expense ratios. Since index funds don't require active management, meaning no fund managers are trying to beat the market, their operational costs are significantly lower than actively managed funds. These lower fees can lead to substantial savings over the long term, directly impacting your investment returns. Index funds aren't a one-size-fits-all solution. They come in various types, tracking different segments of the market. Understanding these types can help you choose the right fund for your investment goals. The most common type are stock market index funds, which track broad market indexes like the S&P 500, NASDAQ, or the Dow Jones Industrial Average. These funds give investors exposure to a wide range of companies and are popular for long-term growth strategies. Then there are bond market index funds, which track indexes composed of various types of bonds, such as government bonds or corporate bonds. These funds typically offer more stability and income generation compared to stock funds, making them suitable for investors seeking lower risk or a steady income stream. Additionally, you can find sector-specific index funds, tracking industries like technology or healthcare, and international index funds, offering exposure to global markets. Now that we've covered what index funds are and their types, let's delve deeper into the overarching advantages that make them a compelling choice for many investors. Index funds offer incredible simplicity and ease of use. You don't need to be a financial expert to invest in them. They are straightforward to understand, and once you invest, there's no need to constantly monitor or make active trading decisions. This makes them ideal for busy individuals or those new to investing. Historically, broad market index funds have shown strong, long-term growth potential. By tracking the overall market, they benefit from the general economic expansion and corporate profitability over time. While past performance is no guarantee of future results, the diversified nature and market tracking strategy of index funds position them well for consistent growth over extended periods. The passive investing approach is a core advantage. Instead of trying to beat the market, which is notoriously difficult even for professional investors, index funds aim to match it. This strategy often outperforms actively managed funds over the long run, partly due to lower fees and fewer trading costs. It embodies the set-it-and-forget-it philosophy, allowing investors to benefit from market returns without constant intervention. Given all these benefits, who exactly should consider investing in index funds? While they're suitable for a broad range of investors, certain profiles stand to gain the most. Index funds are an excellent starting point for beginners in investing. Their simplicity and low risk due to diversification make them a less intimidating entry point into the stock market. You don't need extensive financial knowledge to get started. and they provide a solid foundation for building a diversified portfolio. For those specifically seeking diversification, index funds are a perfect fit. They automatically provide exposure to a wide array of companies or bonds, significantly reducing the risk concentration that comes with investing in individual securities. This makes them a cornerstone for a balanced and resilient investment strategy. Finally, index funds are particularly well suited for long-term investors. If your investment horizon is several years or even decades, index funds can be a powerful tool for wealth accumulation. Their passive nature and compounding returns over time align perfectly with long-term financial goals, such as retirement planning or saving for a down payment on a home. In conclusion, index funds offer a compelling blend of simplicity, diversification, and cost-effectiveness, making them a valuable asset in any investment portfolio. They provide an easy way to gain broad market exposure, enjoy the benefits of diversification, and keep investment costs low. By understanding how they work and their advantages, you can make informed decisions to align them with your financial goals. Remember, investing wisely is about making informed choices that align with your personal financial situation and goals. Index funds can be a powerful component of a disciplined, long-term investment strategy. Thank you for watching.